Hello and welcome everybody to this August instalment of the NZX Virtual Investor Event Series. My name is James Sharp. I work on the Capital Markets Origination team at NZX and join you this morning from our offices in Auckland. A quick reminder of the format for this morning. We're going to hear 3 presentations, about 15 minutes each, and after each of those presentations there'll be 5 minutes for some Q&A. To ask a question, please do so in the webinar panel. There is a chat box, so just enter your question in there. And anything we don't get to today, we'll endeavour to get some answers over to you after the session. That's all for me. Fantastic. We're going to kick into our first presentation, and it's a pleasure to welcome Katie Beith, Head of ESG from Forsyth Barr. Forsyth Barr is one of New Zealand's premier investment service providers across private portfolio management advisory and investment transaction services. Katie is responsible for incorporating ESG principles into Forsyth Barr's firm-wide operations and investment processes. Over to you, Katie. I'll be back in a few moments for some questions. Thank you.
Great, thanks very much, James, and good morning, everybody. I'm really happy to be here today. Thank you to the invitation. Thank you for the invitation to NZX. I think it's a pretty pivotal time for the ESG industry. There's been a lot of criticism and press around it, and today I want to talk about the origins of ESG, how it's evolving, why we're seeing these criticisms, and in my view, the importance of ESG as we look to the future. But first, I just thought a little bit of background on me, and most of my career actually has been in the ESG space. And in fact, it was 2004 that I first got an ESG type of acronym into my job title. And at the time, I was living and working in London, doing my OE, traveling and exploring the world, building my career. And as a fresh-faced and rather green Kiwi, I have to say that at that point in time, I was pretty taken aback by the levels of pollution in Europe. And at the time, I was working for a London-based fund manager, regularly meeting with the top executives of the FTSE 100 companies as they came through our offices on the quarterly cycle to talk about earnings and business strategy, forecasts, general direction of travel for their business. And it didn't take me long to realise that once we as large investors started asking questions around why, for example, BP had let a pipeline leak go unnoticed for 3 months in the Arctic, that as investors we could be very influential in driving improved ESG practices. So that was the start of my career for me, and majority of it has been focused on creating wealth for clients, but a recognition that we have a responsibility to take care of the environment and society while doing so, and also as an investor, a voice that can influence. So I tell this story because I think it's really important not to lose sight of the reasons for the existence of this 3-letter acronym, which is the current focus of so much polarizing attention. So if we move on to the slides, and I'm going to start with, we're just pausing and stopping for a second and just taking a minute to actually understand what ESG is. So ESG stands for environmental, social and governance. And it's a term actually feels new, but it's actually been around for a couple of decades, 20 years. And originally started with a group of investors over in Europe who were recognizing that ESG issues, when mismanaged, can become financial issues. And therefore they should be analysed and assessed just like investors do with traditional financial data. And the early examples that were framing this back then were things like the corporate governance scandals and accounting frauds of Tyco and Enron. Parmalat was another name some of you might remember. If not, I'm showing my age. But anyway, that was sort of back then. And there were things like, the Nike and Gap challenges that they had in rebuilding their brand once they were identified with child labour in their supply chains. So it's issues like this were at the time, unnoticed by investors until it was too late and a significant amount of value had been lost. So the focus was moving to how to get onto the front foot and look at companies and how they're managing these issues and help to sort of find these risks in advance of them happening, and help feed, investment decisions. So ESG, under each of the banners, it's a very broad set of issues, and I'm showing only a small subset here. But under the E, it's things like the carbon profile of a company, or how it's managing its waste and water use, how it ensures it's not negatively impacting biodiversity around its operations. Under the S, it's things like how it looks after employees, surrounding communities. And lots of the S issues have come to light over the recent years of COVID around modern modern company policies and that enable flexi working, which help to attract and retain employees. And under the G, it's things like corruption prevention, responsible tax management, adherence to well-established good corporate governance practices. So there's a lot under these three banners. And what we've seen over the years is investors have looked at these issues and recognised that they can become financially material from an investment perspective. We've seen companies respond and talk to us about how they're managing these issues. Now, rightly or wrongly, and perhaps it's a debate for another time, but ESG does get used synonymously with the word sustainability. And as the way that I look at things and break that down is that I think the three pillars of E and S and G form a really good base of a sustainability strategy for companies, but they are policies and practices that feed into a sustainability strategy. And what happens around sustainability, or what we want to see, is it's the outcome of these policies and strategies, and how how companies are moving towards becoming more sustainable, how they're looking after their operations and not negatively impacting the environment. That's the sort of thing around sustainability, that it's the outcomes of these E and S and G practices. So let's move on to how investors use ESG information. Clicking through to the next slide. I'm really hoping this graphic is familiar to some of you. It's from RIA, which stands for the Responsible Investment Association of Australasia, which is the peak body for responsible investment in New Zealand and Australia. And I think it does a really good job of showing the different types of strategies, and puts them on a spectrum, from the light green to sort of dark green spectrum. And if we keep moving right, we have investing in sustainability related solutions or leaders on ESG management, and that's termed positive investing or sustainability themed investing. And then finally, on the very far right, we have impact investing, and this is where an investment is made with the intention of a positive and measurable impact on the environment or society. And you have some investors who are wanting commercial returns alongside that impact, and then you have others who, for whatever reason within their mandates, the impact is actually much more important than the commercial rate of return. So what I've done on this next slide is to take a couple of the strategies and define them in more practical terms, and then indicate what the actual desired outcome of those different strategies are. Now, I apologise, it's small, but the detail isn't so important here. It's more the ticks and crosses that I want you to focus on. And the reason I've done this, because in my view, I think there are key reasons for the criticism of ESG that we're currently seeing in the press and by regulators. and that it's really difficult for consumers to understand what ESG commitments by investment organisations really mean on the ground in their portfolios. And what I've talked about so far about how ESG issues can become financial issues, i.e. ESG integration, this underpins a lot of the commitments. But as you can see here, it's about understanding the risk and return implications for portfolios or opportunities that might translate in returns. It's not actually about the actual outcome on the environment and society. It's about implications for portfolios. So for a consumer who links ESG with sustainability, it might leave you feeling that you aren't getting what you expect in your portfolio. And what is key is actually working out yourself what is important to you. Is it risk or return? Is it impact? Is it aligning with your values? Or actually is it a bit of a mix of all of those things that I've mentioned? And once you work this out, you can figure out the strategies that sit best with you and hopefully understand the labelling of the different funds better. And this is why we have the current spotlight on greenwashing by investors. And it's not just in New Zealand, but it's globally. So in the US, we've had the SEC investigating Goldman Sachs asset management about claims over their ESG labelled funds. We've also had the investigations into a German fund manager called DWS. And we've had Bank of New York Mellon fined $1.5 million by the SEC for misstatements and omissions about ESG. In Australia, there's been recently published guidance for the super funds over there about how to avoid greenwashing when promoting sustainability-related products. And in New Zealand, the FMA, our Financial Markets Authority, has released a couple of reports recently looking into ESG claims by fund managers and noting that they can be vague. So in my view, this scrutiny is much needed, but it's also a sign that the market is maturing. But I think what's really important is not to lose sight of the key reasons for the existence of ESG. And, you know, globally and in New Zealand, there are many significant environmental and social issues, and the behaviour of corporations will influence these and how they evolve over the decades. We also have investors wanting to their portfolios to align with their values, and then we have this whole ability to influence the behaviour of companies through the allocation of capital and voicing concerns. So to me, this means that there is absolutely a future for ESG, especially with a focus on how companies are transforming to a low carbon, more sustainability oriented economy. And the very last slide that I have here, I guess, shows really the scale of, and gives some perspective to the scale of the transition that's needed. And we're really only at the beginning. So thanks to the International Energy Agency, we have a really clear vision and pathway to achieve net zero carbon emissions by 2050, which are enshrined in legislation here in New Zealand as a reminder. But it also, this particular pathway that is laid out here also keeps us within a 1.5 degree world. So the scale of the transition is huge. The IEA makes it clear that to achieve this, nothing less than a complete transformation of how we produce, transport and consume energy is needed. The report sets out really clear milestones, more than 400 in total, spanning all sectors, for what needs to happen and when, and to transform the global economy from one dominated by fossil fuels to one powered predominantly by renewable energy. So the pathway that they outline, it requires vast amounts of investment, innovation, skillful policy design, technology deployment, infrastructure building, international cooperation, and efforts across many areas. And one of the more notable milestones, which you can see there under 2020, is that beyond projects already committed as of 2021, there are no new oil and gas fields approved for development in this pathway, and no new coal mines or mine extensions required. So I think, it sets out the huge task in front of us, and one that every organisation and person needs to take part. And on that very cheery note, I will wrap up, but just quickly to summarise that I hope today, I've given you a greater understanding of the origins of ESG, the intentions of the different ESG strategies, and an understanding of why it's been receiving so much criticism. I also hope that you can see the importance of it and the role of investors and the role that investors and others all have to play as we make this transition to a more sustainability focused economy. And lastly, I hope that I've helped you to understand some of the labelling that you're seeing on KiwiSaver funds, so you know what you're getting and can make some more informed choices around the strategies on offer. So thanks very much, and yes, happy to open up, James, for questions now.
Thanks very much, Katie. And yes, just a reminder, if you do want to ask a question, please do so via the webinar panel. We do have a question here. You might have referred to it already in the presentation, but quite a broad one. So there are many metrics associated with measuring ESG. What do you think is the most important thing to consider when assessing investments?
That's a very good question. Look, there's not one single metric. I think that so there's a couple of things in there. Personally, I think that how this transformation to a different way of operating in a more sustainability oriented economy is a really big thing for us all, and it's that change in operations and what's needed and the task ahead of us that's quite huge. So I think that's a really, really big, something big to focus on. What I will say is that I don't think ESG data on its own should ever be used as the sole basis for a financial decision. So we all have goals and requirements. We've all got liquidity needs, different objectives, and working, I think it's really important to work with advisors or, with fund managers to understand and get very clear on what those objectives are and how you can build in this awareness and analysis, align with your values and think about your risk return profiles and what your expectations of impact are to try to get the right strategy for you. So there literally are hundreds of pieces of ESG data and information that you can choose from, and keeping that lens on how things have got to change in the future, may well help with the investment decision side of things.
Right, great, fantastic. Thanks, Katie. I think we'll just leave it there, just in the interest of time. So, Katie, thanks very much for your presentation this morning. If you do think of a question you want to ask Katie afterwards, please still fire that across and we can get it over to her and get an answer back to you. So once again, thanks very much, Katie, and see you soon. Thank you very much. And we're going to move on now to our second presentation of this morning, and I'd like to welcome Michael Bacon, Senior Investment Analyst at Fisher Funds. Fisher Funds is a specialist investment manager with a focus on delivering great investment returns and superb client service, and since 1998 have helped thousands of Kiwis on their investing journey. And Michael today is going to talk about the NZX listed Kingfish Limited. Over to you, Michael, and I'll be back in a few moments with some more questions. Thanks very much.
Perfect. Thank you, James. I just want to check that you can see my presentation okay?
We can see you and hear you loud and clear. Cheers, Michael.
Perfect. Thanks a lot. So thank you for joining me, everyone, this morning. It's great to be here, and thanks for your great presentation too, Katie. It's actually an interesting starting point on ESG. I think I might as well touch on it now. So at Fisher Funds, which manages Kingfish, all of our funds are managed under our responsible investment policy. So we don't have specific ethical funds, then other funds that which by inference might be unethical. It's more about managing our all of our funds according to a responsible investment policy and maintaining positive engagement with our portfolio companies to drive positive change. And we do also operate a exclusion list for, you know, companies like thermal coal companies or casinos, for example, where we just don't think that they're good for our clients to invest in. In terms of Kingfish Limited, so it's a listed investment company on the NZX. It focuses on New Zealand equities. So today I'll share a little bit about what Kingfish is focused on, our investment process, and why we're excited about the future for Kingfish investors. Just before I get started, I thought I'd kick off with a question. Can anyone take a guess at what percentage of revenue in the Kingfish portfolio comes from New Zealand? Do we have any takers, please?
With me having the only microphone on this, I think it better be me. So let's go 50% for argument's sake.
Yeah, that's interesting. I'll leave it there and I'll come back to it. So in terms of Kingfish, I think this chart paints a really useful picture. So Kingfish was started in 2004, that's when it listed. And this chart shows the long-term performance, both of the New Zealand market in the blue series, but also Kingfish in the green series, which is the green series showing the outperformance of Kingfish relative to the NZX 50 and its predecessor indices. And that shows to me the long-term benefits of smart active management, which delivers much greater client outcomes. So I think it's much more than just the icing on the cake, and sometimes in some years it's actually the whole cake if the market's in negative territory. And just to sort of give a little bit of context in terms of long-term performance. So if you invested $100,000 in the market back in 2004, you'd have about $440,000. The same figure for Kingfish before fees and taxes is $1,070,000. So that's active management delivering $630,000 cumulatively over 18 years, which is not to be sneezed at. And on a relative basis, this chart shows Kingfish relative to other New Zealand focused funds over the past 3 years. So Kingfish has been the best performing fund over that time. And so I think not only have we delivered long-term outperformance relative to the market, but also relative to peers. You might be thinking, well, how do we actually get there? How do you consistently deliver good performance? What's your process? So for starters, I think if you look at the slide, many of the share market enthusiasts on the call will recognize many of the companies here. But I think what's interesting is also the companies that aren't there. For example, there's no Sky City, there's no Spark. And that's because these companies don't fit our process well. So of 125 companies on the New Zealand Stock Exchange, there's only 15 in the Kingfish portfolio. So that's a very concentrated, and particularly relative to some of our peers who may operate portfolios anywhere from 40 to 70 stocks on the New Zealand market. And why are we concentrated? It's because we've got a high bar and a strict process. We're unashamed in our belief that investing in the highest quality companies with the best growth prospects will deliver the best long-run returns. And I guess said another way, we don't go for diversification's sake. We'd rather invest in great companies that we know really well and do deep research on and sort of spread our bets widely just for the sake of it. It's also worth touching on, what do we look for when we pick these companies? We try to think like a business owner rather than just a financial analyst. It's really important to get out of the spreadsheet and think bigger picture about the industries the companies are in, what their growth prospects are like, and who the people are running the companies. So for example, one of the key things we look for is a long runway for growth, which is why we don't have a company like Spark in the portfolio where earnings aren't expected to meaningfully grow for the next 10 years. We also go for companies with wide economic moats. And by that I mean companies that can compound capital at high rates of return into the future, where their return on capital is much higher than their cost of capital. And a great example of that is Somerset, which expects to grow earnings at 15% per year for the next 5 years, but also earns around a 15% return on equity, which is reinvested into the business. And I think a final point to touch on is it's really important that the businesses we invest in are run by intelligent fanatics. And that might sound like a buzzword, and I guess it is, but actually the substance of what that means is actually much more important. So we're looking for people, again, with that ownership mentality, who own shares in the business and are meaningfully aligned with shareholders. They think long term, they're excellent at allocating capital, they're not afraid to be contrarian, and I guess most importantly, they're excellent at execution and getting the job done. This slide sort of covers Kingfisher's process in action with an example of Infratil. So Infratil is a listed company that manages a portfolio of unlisted infrastructure assets. These assets are hard to access for typical share market investors, and many of the best opportunities aren't actually on the stock market. Infratil's focus is on companies' investments with long-term tailwinds. The plain English way of putting that is simply they invest behind ideas that matter. An example of that might be digital infrastructure like cell phone towers or telecoms investments in data centers, where data growth is expected to grow at 25% per annum for the next 10 years, and they're part of supporting the infrastructure to deliver that tailwind. Another important part of Infratil is also the long runways for growth within their portfolio businesses. So infrastructure is commonly thought of as a category that's safe, a little bit boring, and relatively low growth. But within the investments Infratil invests in, like data centers and renewable energy, the growth profiles are meaningfully higher than the wider infrastructure universe. It's also important to note that Infratil is managed by Morrison & Co, a boutique fund manager who has an excellent long-term track record of managing capital. And the team have meaningful skin in the game. For example, recently, Morrison & Co bought $40 million of Infratil shares for its staff to ensure that they're aligned with Infratil investors, but also participate in the upside that we all believe is on offer. In terms of this chart here, this shows some of the key value realization events we've had over the past 2 years. So back in December 2020, AusSuper, a large Australian fund manager with hundreds of billions of dollars under management, made a takeover offer for Infratil. That was at a meaningful premium to the recent share price, but we actually stood firm against that offer, and publicly so, because we thought that it didn't reflect the value on offer in Infratil. As you can see from the subsequent events there, such as the Tilt acquisition, Infratil has been able to demonstrably realise that value over time. For example, Tilt, which Infratil owned a minority shareholding in, was taken out at 100% premium to its share price, which delivered $2.76 to Infratil shareholders. More recently, we've seen the Vodafone Towers deal, which is pretty incredible. So back in 2019, Infratil and a partner, Brookfield, bought Vodafone for 7 times EBITDA. 3 years later, they've sold the towers business for 34 times EBITDA. And I guess said another way, and perhaps more simply, they've got 80% of their capital back while selling only 10% of the EBITDA of the business, which is pretty awesome value realization, however you look at it. We also more recently saw the Long Road co-investment, where they raised $300 million from an external investor to supercharge the growth of their renewables business in the US. The Infratil stake is now valued at $900 million, having been valued at $200 million earlier in the year, which is pretty incredible value realization. In terms of how Fisher Funds thinks about Infratil and what role it plays in the portfolio, it's a complex business. It has a dozen investments, which take quite a lot of work to get up to speed on and know intimately. That puts some people off doing deep research in Infratil and leads to many fund managers having positions which are similar to the index size, which is sub 10%. We own a 16% share, Infratil is 16% of our Kingfish fund, because we do the deep work to get really comfortable with the investment thesis. And examples of that deep work is, over the past 6 months, we've had over a dozen meetings with not just management, but competitors, industry experts, and supply chain partners. So we're constantly agitating our position in Infratil and whether it's best size to deliver value for clients. And as the past 3 years have shown, with the share price almost doubling, it's been it's exceptionally rewarded Kingfish clients. And I think most importantly, that kind of shows the benefits of active management in action. And while we're unashamed bottom-up stock pickers, it's hard not to sort of touch on what's been happening in the markets lately with incredible volatility year to date. So typically in the long run, share prices are driven by company earnings. But actually what we've seen in the short term, and this chart illustrates it, is that interest rates have actually been a key driver of share prices. So the blue series is the price to earnings ratio for the S&P 500, and the green series is the US Treasury yield, so which has been inverted, because typically when interest rates go up, share prices go down. And so by inverting the series, you can see that they're very tightly correlated over the past year or so. And more recently, investors have also become concerned about the E in the PE ratio, being earnings. Talk of recessions has led investors to be worried about stocks, and we've seen frankly, it's been a pretty tough year to date for markets globally and also in New Zealand. But I think the key point here is that volatility presents opportunity for active investors. We saw this in the initial COVID crisis in March 2020, and we're seeing it again now. But now that I've got the bad news out of the way, the good news is that fear is high. So it may sound counterintuitive that high fear is a good thing, but we all know that it could be a contrarian indicator. Warren Buffett said it best when he said, "Be greedy when others are fearful." And the chart here shows the Bank of America risk or fear gauge, and it measures volatility across asset classes. As we can see from the chart, outside of major macroeconomic events like the tech wreck, the global financial crisis, and the onset of COVID in March 2020, we haven't seen fear this elevated. And that means that investors around the world have become very fearful and very short-sighted. And I think that throws up opportunities for patient, long-term focused investors like Kingfish. So just to wrap up, Kingfish provides a simple way to access some of the leading businesses in the New Zealand Stock Exchange. But a reminder that Kingfish doesn't actually give broad-based exposure to the New Zealand economy. Rather, it's a hand-picked, concentrated portfolio of the best ideas that we see in the New Zealand market. Finally, it's also worth noting that Kingfish is a tax-efficient high entity, and it pays a reasonably high quarterly dividend of 2% of net asset value, or 8% per annum, which we know many of our shareholders appreciate. And coming back to the question that I posed at the start, James, you're very close. It was just 40% of the Kingfish portfolio has earned its revenues from New Zealand. So the point here is that we're not just invested in great local companies, but actually several global best-in-class companies. And if they're able to export and do well exporting, that leaves them with a very long runway for growth and validates their moat as well. So I'll leave that there. I'm happy to take questions, and also feel free to look at our website at kingfish.co.nz. Thanks for your time.
Thanks very much, Michael. I'm not going to take too much credit there. It was just down the middle, so I could have maybe been a bit bolder in my guess and used my brain, but I probably would have gone further away from the actual answer. So thanks very much, Michael. Great presentation. We do have one question here. You referred to the current market, so maybe something that you might want to expand on. So how are you approaching investment decisions in the current bear market?
Yeah, it's a very good question. So ultimately, our process doesn't change. So we take a long-term view on our stocks, and things like the moat of a company shouldn't change materially over time. But what we have been doing a lot of is interrogating the skew on companies, both the earnings skew and the valuation skew. So given it's a highly uncertain environment, just having a base case and saying, you know, stock's worth $30 or $40 and plus or minus that, we can trade around that. That's not our process, but we're interrogating, well, you know, what does a bad or a bear outcome look like? What does a super bear outcome look like? But also symmetrically, what's the bull case? What's the blue sky case? And checking what's priced against that to see what the both the earnings risk and the valuation risk looks like at the moment. And with many of the companies, to be fair, the earnings risk might look bad. We could see some negative surprises to come, but for many of the companies in the portfolio, that's more than well enough in the price. And probably a great example of that is Somerset, the retirement village operator. So they've been trading close to 1x price to book recently, but they've got a land bank that can double the size of the business that they're not getting credit for. And the stock's up about 20% recently from its lows, but we still think that's really not giving much credit to future growth, and we've been increasing our position as a result.
Okay, great stuff. Thank you, Michael. Well, the second question, again, you sound like you might have already answered it, but the question is, which investment in the portfolio are you most excited about, if you're able to say?
That's a good question. Yeah, I probably would say Somerset, partly because it's one of the ones I cover and am very familiar with, and as I said, I think the disparity there is just so strong. But you know, many of our big positions we're really excited about, and Fertillo touched on. I still think there's a lot more to come there. And Main Freight, which is actually our largest position, we're very excited about, and we kind of ruefully joke that we always regret selling shares in Main Freight, just given the long-term track record of the company. So yeah, there's lots to be excited about.
Indeed. That's all for the questions. So Michael, I think we'll leave it there. So thank you so much for joining this morning. And again, any questions that you want to ask Michael after today, please fire them through. We can get them over to Michael. See you soon. Thanks, Michael.
Thanks for having me.
Thank you. Fantastic. And on to our third and final presentation now. And again, it is a pleasure to welcome, we have Mark Lucas, CEO of CANNASOUTH, who's going to be joining in a few seconds. There he is. CANNASOUTH is a vertically integrated biopharmaceutical company dedicated to advanced product development and research. Their goal is to develop next generation medicinal cannabis products for prescribers and patients in New Zealand and export those products and technologies globally. Over to you, Mark. And once again, I'll be back in a few moments with some questions. Thank you.
Thanks very much, and thanks for having me today. I always appreciate every opportunity that I get to help educate around the medicinal cannabis industry and what CANNASOUTH is doing as well. It's a highly complex, highly regulated space. There's a lot of misinformation in the industry. It's always a challenge to try and wrap it up in 15 minutes, so I'll do my best. I've got a brief video just to introduce. The NZX did a great spotlight video feature just recently.
New Zealand's perfectly positioned to play a key part in the emerging medicinal cannabis industry globally. We have all the key components that our international customers are looking for. So CANNASOUTH is looking forward to really taking our brand to the world. CANNASOUTH is one of the leading medicinal cannabis companies in New Zealand. We've got 3 locations. We've got our innovative cultivation facility on the outskirts here of Hamilton. Our corporate head office and research laboratories are based here in Hamilton as well, and then our manufacturing facility is down in Hastings. The medicinal cannabis industry is growing rapidly around the world. There's about 60 countries now that allow some access to medicinal cannabis products. At the moment, a lot of those products are pretty basic formulations. So there's huge areas for development in the space for actually developing more effective therapeutic options for patients and prescribers. And so we're excited about playing a part in that and unlocking some of that potential.
The therapeutic effects of the medicinal cannabis plant are very wide-reaching. Most people associate the cannabis plant with the CBD and THC, but in fact there's over 200 compounds, which is probably why we see a wide therapeutic range. The job now is to try and pull those compounds out, actually understand how they work individually in the body, and that will then lead us to develop some new medicines for patients. So the use of the medicinal cannabis at the moment has a very high focus on pain and helping people to sleep, helping with anxiety. And these are supposed being used where conventional medicines might have undesirable side effects, like the opioids, for example, for pain. So this is just another tool in the toolbox that the doctors can actually use.
CANNASOUTH's been on a real whirlwind journey since establishment. We've developed some world-class facilities here. We've also built a world-class team. We're a people-led business and our people are our key to success. There's a lot of companies out there that are producing generic products, and our goal is to actually unlock new therapeutic options and actually create value-added products and intellectual property, and ultimately returns to our shareholders.
A little bit of who is CANNASOUTH. So we were one of the earliest entrants into the medicinal cannabis space here in New Zealand. The co-founder and I started getting involved in 2015, 2016 when we could see the emergence of this industry overseas. Back at that time, there were no regulations supporting this industry. We were having to work with existing controlled drug regulations and industrial hemp regulations, so very early days. We were the first medicinal cannabis company to list on the NZX in 2019, and we're fortunate to have great shareholder support with currently sort of roughly 24,000 individual shareholders behind CANNASOUTH, so we're very fortunate to have that level of support. We were a founding member of the Medicinal Cannabis Council here in New Zealand. That's an industry body that's working with the Medicinal Cannabis Agency, helping to guide them in regards to how the regulations of this industry are functioning. That's an ongoing process. At the moment, there is a regulatory review that's looking at the medicinal cannabis scheme and trying to look at areas where those regulations can be improved. And so our goal is the development of next generation cannabinoid medicines that support patient health outcomes. And so we're very fortunate to be in a space where we are producing products that ultimately help people. And CANNASOUTH is, and we have established ourselves as a leader in the medicinal cannabis industry here in New Zealand. It's something we're very proud of. So just a quick look at the CANNASOUTH group. So we have CANNASOUTH Limited, which is the NZX listed entity. And then we have three operating operations beneath that. So we've got CANNASOUTH Bioscience. That is the area where we do our research and innovation. We also have our technical support services at CANNASOUTH Bioscience. That's where we'll be commercializing some of the IP that we're developing. We also have all the other support services within the business, from finance, project management, marketing, etc. CANNASOUTH Cultivation is, we have an industry-leading cultivation facility. That facility is producing cannabis flower that can be ultimately a finished product, but also biomass that goes into other products that we'll be manufacturing. And then in Hastings, we also have Midwest Pharmaceutics, which is an existing contract supplement manufacturer, one of the leading liquid supplement manufacturers in the country. And that is an existing business that has got non-cannabis revenues. We're turning over something like $2 million out of that business unit at the moment, and there's good areas for growth in that contract manufacturing space. So a little bit about what is the medicinal cannabis industry. It's certainly a rapidly growing industry globally, with roughly 60 countries now allowing access to medicinal cannabis in one form or another. It's highly regulated. There is a large unmet demand, and this is a patient-driven industry. Unlike normal pharmaceuticals, which is more about a pharmaceutical company producing a product and then pushing it out to patients. In this instance, you've got a high number of patients that have been accessing medicinal cannabis largely from the black market that are now looking for actually products that are produced legally. And so the challenge for businesses like CANNASOUTH is to start to produce products that we can bring those patients across from the black market. It is highly regulated. There are high barriers to entry. Pharmaceutical quality standards are in place in most jurisdictions. And in New Zealand, it is prescription only, and a lot of other key markets that we work in or will be working in are prescription only. So I think that's a key point. A lot of people think that CBD, for example, can be accessed without a prescription. In New Zealand, they are all prescription medicines. Some of the key markets that we're focused on, obviously New Zealand, we're committed to bringing products to New Zealand patients as soon as we can, but we also have to leverage off export opportunities to be able to sustain a highly complex business. And so Germany is one of the biggest markets in the world at the moment, and Europe obviously is a fast-growing market as well. Other areas in Europe. Australia is also rapidly growing now as well. They're a couple of years ahead of us, but they are growing quickly now. There are still quite significant barriers for patients. Price is a barrier for a lot of patients. These medicines are paid for out of pocket. There is, at the moment, in New Zealand, there is no funding support from the likes of Pharmac, etc. And also one of the other big barriers is prescriber education. These are new medicines and there's a lot of stigma around medicinal cannabis. However, we are seeing the likes of dedicated cannabis clinics now starting to open up, which eases that access in for patients. And there is still a real shortage of products as well. CANNASOUTH has recently had our first 3 products assessed by the agency here, and we're looking forward to getting those into the market here in New Zealand. A lot of the products are still very generic. We're at the very beginning stages of this industry. The products are literally THC and CBD mixed in a carrier oil. So there is huge areas for development for more sophisticated and more bioavailable products. And there's also a strong demand for premium cannabis flower, and that's flower that can be used as a finished product. CANNASOUTH is focused in that area, and we think we've got a strong point of difference in that area of the market. So as I mentioned before, our goal is the development of the next generation of cannabis-based medicines. So really, I just want to touch on our strategy. How are we going to do that? Well, firstly, we've needed to establish world-class team, world-class facilities, and world-class capabilities. And we also need to develop phased and multiple revenue streams. This is a global industry, and we need to build a business that's able to compete in the global space. So I just want to talk about some of the capabilities that we've developed. We've gone through a real foundation building phase. To build a business in this sector is complex. It requires a lot of investment. So we've built capabilities in all of these areas. So research and development, our innovation hub has one of New Zealand's leading pharmaceutical development scientists heading it, David Gill. We've got premium cannabis cultivation operations. So the image here, you can see our world-class cultivation facility that is now operational, fully commissioned and operational. That facility is very rare, this type of design out there in the world, and we're getting a lot of interest, highly innovative, and we're really looking at reducing energy usage over traditional indoor cultivation for premium flower. We've also got contract manufacturing. I touched on it before, so an existing contract manufacturing business. And we've developed a lot of technical services within CANNASOUTH as well to support this pharmaceutical business, the likes of QC testing. There's a lot of testing that's involved, and we've wanted to onboard a lot of that within the business so that we can react to things quickly and we can respond as well. So I want to just touch on people quickly. CANNASOUTH people are our greatest assets, and we're our greatest asset. I'm incredibly proud of the team that we've been able to assemble here. We've got over 250 years of combined GMP and pharmaceutical development experience. GMP is a framework for the quality of pharmaceutical products. We believe we have the strongest team here in New Zealand for a vertically integrated medicinal cannabis company, and we've developed a lot of deep in-house expertise: corporate governance, finance, sales and marketing, research and development, formulation, project management, cultivation, manufacturing, quality and regulatory compliance. So you can see how much is involved in a business like this. As I said before, it's highly complex and you require a huge amount of skill sets within the business if you're able to, or you're going to be able to commercialize compliant products. So in terms of revenue streams, so it's important that a company like CANNASOUTH can have those phased and multiple revenue streams to support our activities. In the short term, we've got that contract manufacturing that I've touched on. We've got our first 3 products to come onto the market very soon, finished products, and premium flower, cannabis flower sales from our cultivation facility. That facility is, as I said before, it's operational now, and we're just in the first stages of commercializing the flower that's coming out of that facility. In the more medium term, we're looking at end-to-end medicinal cannabis product manufacture. So that's when we take flower and we run it all the way through extraction and put it into finished product format. And that will utilize some of the IP and technologies that we've been developing in our innovation hub. A lot of these medicines at the moment, as I say, the formulations are very simple. Bioavailability is not great, and so we've been working in that space as well to improve those products and really give us a product differentiation portfolio. And then longer term, obviously, a real key in this industry is developing clinical data and ultimately fully approved products. And when you can do that, you start to open up funding opportunities with the likes of Pharmac, which then reduces the cost to patients. So that's a big project. Clinical trials require significant investment. You need a lot of preclinical work underway to support that and make sure that you're picking the right targets and the right unmet clinical needs. And so it's something that CANNASOUTH is focused on into the longer term. So just going to look now at some of our recent milestones. So we've gone through a real foundation building phase. Again, building a business in the pharmaceutical industry, you don't just switch these things on. There's a lot of investment, a lot of time, but you can see some of these recent milestones, a phase change in the business now. Really, CANNASOUTH cultivation, we commissioned that facility in November last year. And you can see from there, we're really starting to get some of these commercial milestones under our belt now. So our first 3 products were assessed in May this year. That was at the end of a 1.5-year process of product assessment. That will give you an idea of how complex that regulatory approval process is. They join a very small group of products in their category. Due to advertising restrictions, we can't talk about those products specifically, but we're really pleased to be bringing some improved options for patients here in New Zealand. We completed our first commercial harvest at CANNASOUTH cultivation. Again, building that facility during a global pandemic has been a real challenge. At Midwest Pharmaceutics, we also secured a cornerstone customer, Harker Herbals, a great New Zealand brand with great growth aspirations, and we're currently maxed out producing for them at the moment, and so we're looking to expand capacity for them. We also signed a supplier agreement with Wico Pharma in Germany. Now, they're one of the leading wholesalers of medicinal cannabis products in Germany, and we're really thrilled to be partnering with them to take CANNASOUTH'S products into that key market. And likewise, they've been on a global search for international suppliers to support their supply chain, and we're thrilled that they have selected CANNASOUTH in that very small group of suppliers. And then also recently, we've just released some findings from one of our neuropathic pain studies, multi-year studies that we've been conducting, and that shows that CANNASOUTH is working in more than just flower and finished products, but also the science that underpins it and heading towards those finished products and ultimately clinical trials at some point in time. So we'll take some of that key data now and look for potentially commercial partners to help us move that through the next stage of development. So what's next? There's always something next in this industry. We've got a lot to keep working on. We've got GACP and GMP quality certification that we're working through at CANNASOUTH cultivation, export of premium cannabis flower, sales of our first 3 products, expansion of our plant genetics and onboarding program, and commercialization of some of those first products from our R&D pipeline, and also some of those Midwest capacity upgrades that I talked about. So yeah, a lot going on, a very complex industry, but we're thrilled to be able to sort of share our journey with our valued shareholders. So yeah, I look forward to any questions.
Thanks very much, Mark. Thanks for that, and certainly seems like it's been a very busy last few months in particular. We do have a couple of questions here. I'll start by this one. You mentioned or referred to regulation. Are there further developments you would like to see in this area?
Yeah, absolutely. I think for companies like CANNASOUTH, we need to leverage off export opportunities to, to support the business. At the moment, there's one key area at the moment that we'd like to see refined. At the moment, we have to have all of our products assessed against the New Zealand minimum quality standards, but then they also have to be assessed against the export level standards of the importing country. So it's a sort of a double handling, really. And so that can result in additional testing, additional time delays. So that's something that we'd definitely like to see changed.
Okay, thank you, Mark. And then secondly, a question here, what about you at the US market? How much pressure do you get from US competitors?
So cannabis is still federally illegal in the US. So although many states have legalized both medicinal and recreational cannabis, it is still federally illegal. So cannabis is not able to be sort of actively traded outside of the country easily. So what we're seeing too in the US is the major focus is on recreational cannabis, and so we're in the pharmaceutical space. So there is not a huge number of companies in the US that have gone down the full GMP pharmaceutical quality road. So again, many focused on that recreational space. So at the moment, there is not a huge impact from the US market.
Okay. Thank you. And then a final question here, kind of a sort of macro level. Do you have a view on what a mature global medicinal cannabis market looks like?
Yeah, I do. I think longer term, what we're going to see is, I think, a split. Cannabis legalization is starting to happen around the world. So I think over time, you'll see the full pharmaceutical end of cannabinoid-based therapeutics, so approved products, approved medicines. I think the next level down, you're likely to see sort of a supplements and nutraceutical section. So some of the non-psychoactive CBD and other non-psychoactive compounds being used in, more of a supplement space. And then you've got the recreational, which is another end of the market. So we're already seeing that in markets like the UK, for example. CBD is regulated as a nutritional supplement over there. So as opposed to New Zealand, where it's regulated as a full pharmaceutical.
Okay, interesting. That's all the questions we have actually, Mark. So I think we'll leave it there. So thanks very much for your presentation and time this morning. Great to hear about how everything was going. And thanks to all our presenters and of course to you, our audience. We'll be back in a couple of weeks, I believe, with another event. So please do tune in for that. And otherwise, enjoy the rest of your day and catch you soon. Thanks very much. Bye-bye.